In this final part of our Chapter 2 lecture, I'll introduce the primary sustainability ratios. I'll also introduce the methods we use to identify the appropriate competitors to a firm, and I'll discuss some problems with financial statement analysis. Sustainability ratios, or payout ratios as they're sometimes known, tell us as investors what the firm does with its profits. Does it pay out those profits to shareholders, or does it reinvest those profits in new operations? Normally, a firm will use its net income to reinvest in new capital budgeting projects. It might also pay out as a dividend to shareholders that cash, or it might even repurchase outstanding shares to reduce the number of shares outstanding that it's going to have to pay dividends toward in the future. We have two primary sustainability or payout or retention ratios we frequently refer to. They are the dividend payout ratio and 1 minus the dividend payout ratio, otherwise known as the retention ratio. The dividend payout ratio and retention ratio tell us what percentage of net income is being provided by the firm to shareholders. Higher dividend payout ratios indicate the firm is paying out larger amounts of cash. The drawback to this is that the firm can't reinvest that cash in future operations. This is why many firms have extremely low payout ratios. Most tech companies and small firms have dividend payout ratios of 0. The reason for this is because the goal of these firms is to compete and grow quickly. If you're trying to grow your firm, internally generated cash is much more preferable as a source to fund new capital budgeting projects than issuing new shares of equity to the public or borrowing from a bank. All right, let's take a look at Macy's and we'll calculate their dividend payout ratio. So here's their income statement, and as you saw from the previous slide, the dividend payout ratio is just dividends paid out divided by net income. In this case, we know that Macy's paid out a grand total of $395, that would be in millions, and they earned net income of $1,072. Now the dividend payout ratio is just dividends divided by net income. In this case, 395 divided by 1,072, or 36.87%. Now this tells us that the firm is paying out 36.87% of its profit to shareholders, which means that it really only has about 63.15% of its net income to reinvest in new operations. Those new operations could be opening new stores in California or overseas. They might also purchase a new brand or acquire a direct rival. So this is why typically we see high growth companies, firms also in the tech sector that don't have a very high dividend payout ratio. All of the ratios I've shown you in this lecture can be compared to their historical values or their values at other competing firms. We refer to the analysis of one ratio over time as time trend analysis. The goal of time trend analysis is to identify significant changes through time. The comparison of ratios across firms is called peer group analysis. Peer group analysis involves us comparing our firm's ratios to ratios of companies in the same industry using either SIC or NAICS codes to determine the firm's competitors in the same industry. SIC codes have been used for many years to identify industries and allow for comparison with industry average ratios. The SIC codes are limited, however, and have not been keeping pace with the rapidly changing business environment. Consequently, North American Industry Classification System codes were developed in 1997 to alleviate some of the problems with SIC codes. Notably, these came about after the rise of the internet. Now, every firm has a primary SIC code. SIC codes are used to identify a firm's industry. The codes are easily searchable, and if you want to see the primary code of a firm, all you have to do is go to the link that I've provided here, siccode.com, and you can literally look up any publicly traded company and see what its primary SIC code is. All right, here's an example of the SIC codes out there. So I've copied all of the SIC codes currently used in the industry right here in today's Excel spreadsheet. So for example, an SIC code of 1000 indicates that a firm is in the metal mining industry, whereas the SIC code of 1400 indicates that a firm is in the mining and quarrying of non-metallic minerals. NAICS codes are a bit more involved, and obviously you can see that these are a bit longer. Why? Well, it's because there's a lot more of them and there's a lot more detail provided in them. So we can see that there's actually a difference between wheat farming, corn farming, and rice farming. So if you want to know what industry a firm is in, you can, again, go to the SICcodes.com website and see what they're in. One of the biggest issues with SIC codes and NAICS codes is the fact that some firms are conglomerates. General Electric is a perfect example. The firm operates across multiple industries and has been involved in the electrical machinery, power generation, and even the banking industry. Because of this, it would be inappropriate to only compare GE to a firm in the electrical machinery industry. This is one of the biggest problems we have with ratio analysis. However, there's a whole list of others. Another problem with ratio analysis is that firms can have global competitors that use different accounting techniques. Right now, most countries require their firms to use IFRS accounting standards, but US firms will frequently use GAAP accounting standards. International firms, particularly those headquartered in third world countries, might also have numbers on their financial statements that are extremely misleading or just plain inaccurate. So many times, ratio analysis with these firms, as our comparables, would not be appropriate. Another issue with financial analysis using ratios is the fact that different firms can have different fiscal year ends. If you're comparing two firms in the same industry and the industry is cyclical, say for example like the retail industry, one firm's annual report might take into account the most recent Christmas shopping season, but its direct competitor's annual report might take into account the previous Christmas shopping season, because the firm's fiscal year end was September 31st rather than December 31st. There are a host of other issues that make it difficult to interpret ratios, including differences in the capital structure across firms, or the fact that one firm recently suffered a one-time event, like a warehouse fire that depressed its net income during the year. All of these different factors mean that we need to view ratios we calculate with a bit of suspicion or skepticism. These ratios provide us as financial analysts with indicators of past operations, but we should always try to acquire more information about the firm's operations, particularly when we see ratios that tell us two different things. So that's it. In this section, we introduced payout ratios, also known as sustainability or retention ratios. I also introduced you to SIC codes and NAICS codes. Finally, we discussed the problems with ratio analysis. If you do have further questions, please don't hesitate to contact me via email or phone, or you can also just walk into my office. Keep in mind, I do have an open door policy. Thank you very much.